This is a relationship business, and people are going to invest with you because of the relationship you have with them. People don't care what you know till they know how much you care.
Welcome back, passive investor, to another episode of the Passive Income Adventures. We're putting together a little mini series right now on securities violations and white collar crime, because I know that the biggest impediment to investing can be fear of how much time it takes to learn something, but fear that the person that you're investing your capital with is not going to do a good job of taking care of that. And learning more about this side of things, instead of creating more fear, I find can actually be empowering. Education, and the more you know, the less risk you take. So our guest today is Mike Morawski. He is out of Chicago, and he has quite a story to tell about some securities violations that he committed after the financial meltdown in 2008, where he basically did the cardinal sin of moving money from project A to project B without disclosing that to his investors, otherwise known as a Ponzi scheme. The penalties for this are extremely harsh. And so as an operator, I have found it to be incredibly important for me to educate myself on what the law is, why the laws are there, how they protect investors, and how I can make sure that I don't run afoul of them for my own personal protection, but also to protect investor capital. Mike has learned some amazing lessons coming out of this with an incredibly positive attitude, and has been vulnerable and sharing his story. There are two types of people who commit infractions: those who get caught and those who don't get caught. And of those who get caught, there are the ones who can admit what they did was wrong, whether they did it intentionally or unintentionally, or those who cannot admit what they did was wrong. They maintain the mental exercise, the gymnastics somehow that justifies everything that they did. They understand that people lost money, they understand that people got hurt, but they refuse to take any acknowledgement for their role in that. And finding somebody who can learn from their mistakes, communicate those mistakes clearly, like I said, in a vulnerable way, is extremely important to building that relationship that you need with a sponsor before investing in a deal or before partnering on a deal with anybody, whether you're an active or a passive investor. So come along for Mike's story. Again, the level of introspection and personal development that he's gone through after making some cardinal mistakes in business, growing too fast, not paying enough attention to the details, being more focused on acquisitions than he was on business plan execution, and then finally running afoul of some pretty serious regulations. How he's come back out of that post-prison, post-pandemic, and he is now rebuilding his multifamily business with the blessing of the Securities Commission, and how experience and relationship trumps everything in this business. Thank you for joining us today, and enjoy the show. Hello, passive investor. We have Mike Morawski with us today. He's from Chicago, Illinois, and he is the chief investment officer for several hedge funds. He has the website MikeMorawski.com, and My Core Intentions is his investment company. And Mike is here to share with us a really unique story. It's part of a series that I'm doing on how to do due diligence on your sponsor and your operator before you put your money into a deal. So thanks for joining us today, Mike.
Hey, thanks for having me, Emma. I've been looking forward to this.
I'm really excited to talk to you today because your experiences with dealing with securities and having some tough lessons that you've learned can really help the investor to take a step back and really look at all the possibilities. Because what we're trying to do here is help people design their passive income lifestyle. And part of that is being able to invest their capital with people who can take care of that capital for them while they're off on their passive income adventures. And so can you tell us a little bit about your background and then how you can help investors basically figure out if their money is safe where they're putting it?
Yeah, let me do my best about helping people understand safety of their money. I've been in real estate for 30 years. I started out on the residential side, came from a construction background. I had a large general contracting business and just burned out. Decided to go into real estate, was very successful from the start. I sold 79 houses in my first 9 months in the business. And that was just because I put some fundamentals and models in place that I followed every day and became really successful as a result of that. Built a team selling over 125 listings, and 2005 rolled around, and I did that for about 12 years. And then 2005 rolled around and I saw the market starting to soften, and I wasn't really sure what was happening or what was going to happen, but I knew the market was going to change. Similar to where we're at today, right? We see the market changing. There's a softness in it, but not real sure where it's going to go. So I had always wanted to be in the apartment business. So I decided, let me go syndicate an apartment, my first apartment offering. So in 2005, I went out, I bought a small 11 unit apartment building in the Northwest Suburbs of Chicago and learned a lot, Emma. Things about buying strategies and due diligence and how to underwrite properties. I learned a lot of that on my first couple of deals. But I bought that first deal. And then from there, over the next 30 months, I raised $18 million, bought 4,000 apartments in 5 US markets, built a property management company managing 7,500 doors, and grew that company to just about $100 million in value. Emma, 2008 rolled around. The market really started to soften. We started to unravel. And one of the first mistakes I made that I always tell people to be aware of is we grew way too fast. I took on too many assets, too many employees, thinking that somebody was stabilizing these assets, and nobody was. And mistake number two, I didn't pay attention to the details along the way because I kept trying to buy more assets, raise more capital, build the business. And so 2008, we started to unravel. By 2010, we had really hit a brick wall. We were invested in markets like the Ohio Valley, where we didn't have a lot of employment diversification because there were only a couple types of employers. Those employers got hurt worst back during the economic crisis. So our occupancies dropped, our NOI dropped. We didn't have money to pay bills nor pay investors. We had some deals that we should have just let go to foreclosure and a few investors get hurt, but I didn't want that to happen. I didn't want any of my investors to get hurt. So I thought, let me try and save the whole company. I was thinking, hey, this is just a recession. It's going to last 10 or 12 months. There'll be a 10% correction in the market. Everything will bounce back. And that didn't happen. It was 7 or 8 years with a 40% correction. So I scrambled trying to figure out what I could do. I started to move money from profitable companies to non-profitable companies. And at the guidance of my attorney and my accountant, they both said, it's okay to do that. Just leave a paper trail. And their thought too, in their defense, their thought too was that this is a recession. It's just going to last a short time. Nobody had an idea what we were hitting. But here's what happened. I didn't disclose to my investors the movement of money. And when we take someone else's capital, we are held at a much higher standard, at a higher level. And because of that non-disclosure issue, I wound up being charged on wire fraud and mail fraud charges. And I got sentenced to 10 years in federal prison as a result of it. Needless to say, lost everything, went off to prison for a 10-year period and learned a lot. A lot of people would say, oh my God, how did you handle that? What happened? And I say, what did I learn? Because I learned a lot. So while I was gone, I took on the mindset that I was going to do something different with my life. And I wasn't sure what it would be. I actually didn't think I'd ever go back in the real estate space. While I was gone, I wrote 2 books. I wrote a book called Exit Plan, which I'd love to give one copy to all your listeners. I wrote a book on property management. Hopefully will get published this year. I wrote an ethics course. I taught real estate investing, property management, and ethics in prison for 6 years. I went to college. I got a bachelor's degree in theology. I was on an outreach program and went into the community. I told my story 40 times to local business owners and college students. And I met a professor from the University of Minnesota. And he and I co-authored a paper together that we had published in the Business Journal of Ethics that gets taught today at the collegiate level for forensic accounting and sales and marketing classes. So I served just about 8 years. I came home about 2020, just when they closed the world down for the pandemic. So I jumped from one prison right into another, was on home confinement for 10 months. And during that time, I started a coaching and training business and wanted to work with real estate investors, multifamily investors, teaching them how to scale their business and not make the same mistakes I made. And I believe everybody needs a coach. But Emma, more importantly than that, I got approved by the SEC to go back be an issuer of securities, sponsor deals, and raise capital again. And I partnered with a couple of my coaching clients. We did our first deal a few months back. We're working on the second one right now. And so life is kind of full cycled here a little bit. Now, it's not all wonderful, right? It's been a lot of hard work and a lot of mindset getting along. I still have some distorted relationships with family members, but I do the best I can every day to be there for other people.
There's a lot to unpack in that story. So I have a couple of questions. I'll just start off. When we first relocated from Austin, Texas to Salt Lake City, I gave up my business. It was on location photography, and I spent a couple of months in Utah trying to rediscover myself and figure out what to do. But what I was coming up here was close to a lot of my friends basically having a lot of money stolen from a Ponzi scheme. And the perpetrator to this day will not admit that what he did. And it was basically moving money from project A to project B without disclosing, but it was enough money he could have gotten a life sentence. I think he got just under 20 years. And like I said, to this day, just says, hey, we had some investments that went wrong. I feel really bad for my investors, but I didn't do anything wrong. And I was coming out of that thinking about the mental gymnastics that he was putting himself through in order to justify the actions that he took to be so egregiously found guilty of all of this money that had been lost. And my friends, millions and millions of dollars lost. And I was wondering, if I'm getting into this real estate thing, how do I protect myself from committing the same types of fraud? Because I didn't know anything about it. And I was comparing that to a woman who would speak to us in business school where she had embezzled money from her employer. She was an accountant. And when she finally came clean, they said, we have to report you. She went to prison for 3 years, but then came out of prison and put together an ethics course and went around and taught university students. And I was comparing her story, basically her saying, if you think it can't happen to you, then it's more likely to happen to you because you don't know what you're talking about. You don't know what you're doing, and you haven't faced up to the realities of what human nature is like, versus my other who couldn't admit what he did was wrong. Now, you've come out of this story having written ethics courses, books, really doing a deep dive into yourself and thinking like, what can I learn from this experience? And it all comes from just that lack of disclosure, which seems like a minor thing, but it carried a very heavy penalty. So what was the difference between you coming away from this? What can I learn? What can I teach? Versus people who are still going through the mental gymnastics to cover up and justify what happened, either out of ignorance of what the law actually is, or something that they did that they can justify somehow.
Yeah. So one thing I want to say is I think everybody arrives at a place at different levels. I could have walked away and said, boy, I didn't do it, but I broke the law. I didn't disclose to my investors. And I said it a minute ago, we are held at a much higher standard.
Yeah.
And we have to respect those people. We have to respect the rules and the law. And bending the truth or bending situations doesn't help anybody. I didn't think that I would ever go back and raise capital again. Mm-hmm. I never thought I'd do 100 or a 200 unit multifamily deal. And before I knew it, I was doing 300 and 400 unit deals. I think we get to a place where our mind shifts at some point. Here's what I know. If you're an investor and you're looking at a sponsor, just vet the sponsor. Make sure your head and your gut are in sync, right? Because there's plenty of people that can tell you what you want to hear and haven't had any experience. And there's plenty of people that are going to tell you the truth and have had some experience. And I've had some experience. When I say I didn't think I'd ever raise capital again, I was on a meetup one day telling my story, and there were about 100 people on, and somebody said, hey, are you raising money again? I said, no, I don't think I would. He goes, why? He said, because I wouldn't want to invest with anybody other than you because you've already made the mistakes. You know what's happened. And I talked about 2 mistakes right out of the gate, right? I grew too fast, very unstable as a company. I didn't pay attention to the details, but more importantly, I was over leveraged. I owned $60 million worth of real estate at 85% loan to value. Emma, I don't know who was worse, me for taking the money or the banks for giving it to me.
You. Yep.
But I tell people today, don't get in a deal unless there's 65 to 75% leverage. in that deal. The other thing is I was undercapitalized. I didn't have enough money to fund. And then I did something really crazy. I took the provision out of our private placement memorandums that said we could go back to our investors for a capital call. So I
Oh,
didn't have that option to go back to my investors when we were in trouble. So I tried to fix it because I'm a hero. I'm the oldest born, right? I'm a hero. And because of that, I thought I could fix it. And it didn't happen that way.
so we are dealing with a lot of capital calls right now, not in our properties, but just a lot of our network. One guy, he has 8 properties in the middle of a capital call right now. And so he had to pull out of an investment because he needed the liquidity to feed the capital calls because things are just tough right now. The rates are going up. We have adjustable rates on our bridge loans, and it's really caused a lot of difficulty. But at the same time, I just keep reminding myself, we just funded our capital yesterday, and keep reminding myself, like, all we need to do is keep this thing out of the hands of the bank. If we can just save it from the bank, we'll be fine. And so even though capital calls are pretty awful from an investor relations standpoint, if you don't have the ability to pull the property's head back above water and save it from the bank during a downturn, it can really cause havoc, as you've said. So I think it's important for investors to remember, like, capital calls are in there for a reason. Just make sure when you're looking at that, that they're not overly punitive if you don't fund, if you can't fund. So what do you do now for capital calls? Because it's, like I said, it's terrible from an investor relations standpoint, but what's even worse is losing people's money or having a property be foreclosed on. So how do you build your capital calls now to make sure that you're safe, but also still protecting investors?
Yeah, so I leave the provision in now. I don't take it out. The attorney that went and got me by the SEC, that was a long conversation we had
Mm-hmm.
about that, right? And she said, don't do that again, because if you ever come in a situation where you need capital for operations, you have to be able to go back to your investors. You're all partners. Everybody who invests in these deals is a partner. Now, you hope that in the great scheme of things that you're not going to have to, as an owner operator, go
Mm-hmm.
back and raise additional capital on a deal. The last thing you want to do is liquidate your ownership, your shares.
Mm-hmm.
But there are those situations where if you are going to lose the property or you don't have enough money for some major repair that has to happen all of a sudden, say you own a property with a chiller repair could be as much as $250,000.
Yep.
And if you don't have the cash flow or the reserves, you have to go back and do a capital call. They're out there for everybody's protection. And what I did was kind of a silly thing by taking it out of the documents. But you know what? We learn, right?
Yep. Another thing that I've often heard people ask an operator is, how much skin do you have in the game? Meaning, how much of your own cash have you put in the deal? And what I've found over the last couple of deals that we've either been managing partner on or that we've invested in as minor partners or limited partners, it's not so much how much skin they have in the game up front. I want to know how much skin they can put in the game if things go bad so that they can avoid a capital call. So basically, they're starting with a general partner capital call, that where they're putting the cash in themselves and they have those personal reserves and that liquidity to be able to put it in so that it doesn't get down to a limited partner capital call. How do you typically put your limited partners from being able to have to go through a capital call by having extra working capital or general partner capital so that you can go to that pool first? So your own skin in the game.
Yeah, great point. I think when a capital call happens, it has to happen equally on both sides of the line,
Mm-hmm.
right? So your A class shareholders, which are your general partner, your sponsorship team, and then your B class shareholders, your limited partners, or reverse. So your A class shareholders are your limited partners, and your B
Mm-hmm.
class shareholders, your GPs. Everybody equally has to participate in that capital call if it comes.
Yeah, we have COVID, especially when it first hit, and we didn't know what we were dealing with yet at that point, and the moratoriums. There was a lot of talk about just cutting off distributions, like we're just piling up an emergency fund, piling up a working capital fund. And most of our investors understood, not just mine, but across the industry. I just heard people saying, hey, just do what you need to do to keep this property solvent because we don't know what's going on in the face of uncertainty. So ceasing distributions is probably like the first line of defense. GP capital calls, and then the last would be an LP capital call. But I'm interested what you say. Like, when you do a GP capital call, do you immediately go for the LP at the same time, or is the GP putting skin in until they can't put skin in anymore?
Well, Emma, I think that depends on what's needed.
Mm-hmm.
If you need $1 million, just making this up as we go along,
Yeah.
if you need $1 million for a capital call, shouldn't that be the responsibility of all the parties? So everybody equally weighted based on their investment portion should be able to put in the equal amount. Again, making this up, let's say it's $1 million. The GP side should put 30% of that in up front,
Mm-hmm.
right? And then the LPs make that difference up.
One thing I always caution when I'm talking to limited partners, especially before their first investment, is to have an emergency fund just in case something happens. And so typical capital calls would be what, like 10% of the total invested. So if you put in $50,000, that's $5,000 to set aside. And for each deal, having about 10% set aside for each deal, just in case things go wrong. So an emergency fund from a limited partner standpoint is extremely important because none of us want our operators to get into the situation where they're having to figure out how to keep this ship afloat because they don't
Right.
want to do a capital call, or as in your case, you weren't able to do a capital call, to go back and maybe put that provision in later and change things up on people. So what do you generally recommend limited partners do to make sure that they can stay solvent during a situation where the property might not be doing so well?
I do the same thing. I think that you have to have a little bit of money, especially if somebody's got a self-directed IRA or a trust fund. Don't deplete it. Make sure you have some money set aside for that situation if it should arise. But better than that is, I think that if you get in a deal where, and I know things always happen, but here we bought a deal in Tampa, Florida, where the interest rate at 4.5% is lower than what the cap rate was. There's that inversion piece too, right? If you're going into deals where the interest rate is higher than what the cap rate is, you're setting yourself up for a situation that might not be good. I think that you need to make sure to keep that distortion in place. You are making sure that you're looking at the deal, looking at the sponsor. What are those? It's not just about the return, but it's about what are the fundamentals or the mechanics behind it to get to the return. And I think one of the big mechanics is have an interest rate lower than what the cap rate is.
The purchase cap rate?
Right,
Okay.
you're going in cap rate.
So this is a good point. Can shift gears a little bit to what you're working on now and what you're doing to educate your investors on what they should be looking for to make sure that their team is experienced enough to get the property through tough times, but also that the property itself has the financial fundamentals to be able to survive. And this is where it gets into the weeds for most investors. They start listening to this kind of stuff and they're like, oh man, I don't have time. I don't want to think about this. I don't know anything about this. Maybe they're an expert in engineering or IT or medicine, and they just don't have the time to be able to learn all of this about what they're investing in. What's your advice there? What are the key metrics that they should look at, top questions they should be asking so that they can still focus on their core specialty, but still be able to enjoy the benefits that passive income from commercial real estate can offer?
Yeah, I think everybody needs to have some KPIs, some key performance indicators that they watch. I know when
Mm-hmm.
we asset manage a deal and we're overseeing the property manager or the boots on the ground, we have those KPIs in place. And it starts with what's your vacancy. And if your vacancy is too high, you know that you're not getting enough traffic through the door. So how do you change your marketing strategies? And I think that a passive investor needs to at least understand this stuff from a 10,000 foot view so that when they get on a partner call or they get on a quarterly investor call, they keep up with that terminology. I think people need to understand the difference between physical and economic vacancy. People need to understand where the revenue's coming from and how we're getting to an NOI number and how NOI affects the overall value of the property along with cap rate. Rates are really important. You look at deals today, I don't know the reason you have a capital call in a deal, but I think it goes back to that interest rate being higher than what the cap rate, purchase cap rate was, because we went in a lot of markets, pricing got so high, cap rates got so low, interest was in the middle there, and
Mm-hmm.
now there's a decompression in the cap rate and it's causing some distortion. I think people need to know about underwriting fundamentals. I look at it like this. There's three ghosts. Did you ever watch the movie The Christmas Carol?
Yes.
So you got the ghost of Christmas past, the ghost of Christmas present, and the ghost of Christmas of the future. And you have to look at all three of those categories when you're putting together underwriting. And I think that the average investor needs to at least understand some of the fundamentals. And what do I go through as the head of the underwriting and due diligence to make sure that my investors are safe? Because that's one thing I'll never do again, is let my foot off the gas of paying attention to the details. I'm always going to have my hand on the pulse of the KPIs after we bring a deal to the market.
Let's talk a little bit about overcoming fear. So, an investor overcoming fear, oh, there's so much I have to learn. I don't feel like I'm going to be confident enough to be able to put money in here. But the fear that you've also had to overcome yourself, having that injunction removed so that you can go out and raise capital again, like that, I'm terrified of raising capital because I don't know what I don't know. And you
Yeah.
being in that situation, speak to the investor about your experience overcoming fear and what they can learn from your experience.
A lot of times people have this fear because there's some unspoken thing that they think in their life that either it's too complicated, so they don't want to do it, or they
Mm-hmm.
don't have the education. Both of those things you can overcome with some education and just learning some fundamentals. Get with a sponsor who, like yourself, who's willing to take the time to explain something to somebody,
Mm-hmm.
right?
Good
Who's
teacher.
willing to spend that extra amount of time on the phone or on a Zoom call with somebody, showing them underwriting and how the line items work. The other thing is people don't get involved because exactly that. They think investing is risky. Emma, if you look up the word investment in the dictionary, nowhere does it say that it's a risk. What it says is it is the purpose of putting money into an investment to give you a return back. And that's what the purpose of it is. Because you might be afraid of going into a real estate offering, does that mean you'd be afraid to invest in Google stock too? Which you can't leverage,
Yeah.
which you can't dictate the return, which you can't force equity, which you can't force appreciation, and you don't get any depreciation from it. I don't know if that brings some insight to that or not, but
Well, it sounds like it all breaks down to trust. Let's take the Google stock example. When we buy Google stock, it's because we feel like Google's a great company. They have a lot of experienced people there. They've been doing some really cool stuff. Their returns in the past have really been predicting possible returns in the future. And we just trust that they're going to do a good job. When we're buying a security, we are a limited partner. We have absolutely no say, no vote, no control, which is a double-edged sword. I love that I don't have any control because then none of my other limited partners have control. And I don't have a bunch of business partners that suddenly, like if we did some sort of hostile takeover, now I got all these business partners and I'm like, I don't know who these people are. So I love the fact that we don't have a say in what's going on. But at the same time, you really have to trust, say, Google, that they're going to do a good job with making sure that those stockholder returns are taken care of. So when you're breaking it back to trust with an operator, it's a much closer relationship. It's a much closer relationship between a general partner and a limited partner because they can call us on the phone, they can ask us about the deal, and finding someone who not only can teach and is willing to teach but can't help but to teach, that
yeah.
loves teaching, that has the information and just pouring out. How do you recommend people get that trust in that operator and develop that relationship so that they know that their money is in good hands? There is some risk to it. It's money you can afford to go to zero is what we always say, and just that hope that it doesn't, but that if it did, you could survive. How do you
Yeah.
develop that level of trust with your operator so that you know that they're going to do a good job?
This is a relationship business, and people are going to invest with you because of the relationship you have with them. Yeah, sometimes people are going to invest just because they're looking for an opportunity and you sound good at the time. But most of the time, this doesn't happen overnight. It's a
Mm-hmm.
long term game. If you're somebody who's looking to be a sponsor and go out and syndicate deals, just understand this isn't a sprint, it's a marathon, and it is a long term game. And you be willing to build relationships with people. People don't care what you know till they know how much you care. So the more time you spend with somebody, the more level of comfort they're going to have with you.
Mm-hmm.
And if you're genuine and you are realistic and you come from a place of giving back versus what's in it for you, you're going to do well, and your investors going to see that. And listen, it falls on both sides of the aisle because I've had investors come and say, I want this, I want this, I want this. And I'd say, yeah, we don't do that in our deals. I know there's sponsors out there that will, and I don't think we're a good match.
Mm-hmm.
So it's okay for a potential investor to say, hey, I'm not a good match with you, but go on that double gut and head check. Make sure your heart and your head are in sync on the deal.
Yeah, I always look for how excited are they when they're talking about money? Because if they're really excited when they're talking about money, that's a red flag for me that I might not want to
Oh,
invest with them. Are they doing this to give people a great, nice, affordable, clean place to live, and in exchange they will be paid well? That's a different story. But if somebody's talking a lot and they're getting very excited about how much money they as a sponsor are going to make, and they don't make it about the resident, they don't make it about the investor, to me that's a huge red flag.
what a great point. That is such a great point. When I think about it, my mission has always been to provide safe and secure housing for my tenants. And I think a lot of it comes because I really grew up in a single mom household.
Mm,
And not that there's not single dads out there, because there are, but I know those parents when they're at work, they want their child to come home and the door in that hallway closed behind them, or that apartment door closed behind them, and they feel safe. Right. And they know that they're not going to get hassled by a drug dealer, a gangbanger, hustled into a gang, and that things are going to go smooth. So we really try to provide that safe and secure housing, but I also try to provide short term cash flow and long term wealth. I don't think
mhm.
you can have one without the other. That's why I buy in the markets I buy in, is because it provides both. Where if I bought in Chicago, it really only provides cash flow. I don't
Mm.
have that long term wealth appreciation. So you have to look at the markets. So look at your sponsor as how are they evaluating markets and deals, and what's their buying strategy? What are those market evaluation traps that they're looking at? And I think all those things come into play.
As an investor, I really value delayed gratification, long-term planning, long-term success. And I find that if an operator is also really focused on the short term, they're more of an entrepreneur and less of an investor. And I'm trying to find somebody who has more of an investor mindset than a business owner mindset. And maybe that's the difference. It's a short-term balance with the long-term, like you talked about, is really important to figure out like how important is each one to this person. If it's all about long-term, yeah, that's great, but I need to retire and I need some cash flow. And it's all about short term. Sometimes the customer service at the base of the business isn't actually going to go that well because they're looking to just turn it over quickly and they're not caring as much about safe, clean housing for the residents.
Yeah, I think it just goes back to what are we giving back to others?
Mm-hmm. Oh, yes. And you said something when I interviewed on your podcast recently. You talked about how the biggest indicator of professional success is the level of someone's personal development. I think you've really embodied that in the things that you have walked away from, walked through, and being able to come through that with the mindset of what can I learn from that? How can I develop personally? And that will only help my professional development. The self development comes first, which sounds selfish, but can you talk to us a little bit more about that?
I said that because that's brilliant.
Yeah, that was pretty good.
Yeah, thank you. Yeah, I what my comment always is, I don't think any of us grow professionally till we grow personally. And so what are you doing? What time are you taking to your daily disciplines? It might be prayer, meditation, exercise, eating, gratitude. What are those daily disciplines that you're embodying? As well as what are you putting into your mind? Are you reading? Are you listening to podcasts? I think the best way for a passive investor to get to know really who a sponsor is, go to their podcast, listen to their material, listen to how they interview somebody else, because I think the true sense of who somebody is going to come through on that. But yeah, we all need to continue growing. I love reading, I love writing, and it's those are the things that help you grow.
Exactly. And I don't think you can listen to somebody for hour after hour and not get a good sense of who they are. Yet at the same time, it's still not enough to just say, oh, well, this podcast sounds good. I'm going to throw money at them. So being able to go through those background checks. Now, if we look at the story that you told earlier, the friend that I had, that his first offense, when the one he went to prison for, he didn't have any securities violations before that. No problem. He came up completely clean on a criminal background check, completely clean on a securities violations check. His first offense was major. And so how do you do a background check on somebody who doesn't have any violations, and in your case was trying to do things the right way with your professional accountant and your attorney guiding you through that process? Nothing would have come up on your background check. Is there anything that investors could have done differently in the deals that they were in with you in your early days that they could have asked about you, your background, or your business practices that might have helped the situation?
I had built a couple of successful businesses, and track record was one of success.
Mm-hmm.
And listen, I'll never tell you I didn't break the law because I broke the law. But I also know that 5 years before I got in trouble,
Mm.
before all the Bernie Madoff stuff
Yeah.
happened and all of the white collar things happened, the SEC would have stepped in. They would have slapped our hand, fined us $250,000, told us to
Hmm.
go back and fix everything, and we'd have had an opportunity to fix everything. But today, the federal government destroys everything that you have going on. I broke the law. I take full responsibility for that. And I'm sorry for the investors that got hurt. But I also believe that was part of my personal journey and what I learned from it. What could people have gone back? I was home most nights for dinner. I was the
Hmm.
neighborhood baseball coach, the neighborhood soccer coach. I loved what I did. I was passionate. I built into people. I employed people. My goal was to have a company that employed 1,000 people, that we could serve them and their families. My character really wasn't one of
Exactly.
breaking the law or being a criminal. But something happened in my life that caused me to try and fix everything. And because of that, I broke the law. I don't know, Emma, that you can go back and really check on somebody.
Hmm.
Here's one thing that I do when I'm interviewing somebody for a tenant or a job
Hmm.
is my goal is to always go 2 to 3 deep. So if I'm going to get a referral from you, Emma, because you want to rent a unit from me or you're going to go to work for me, I'm going to get a referral from you. But then when I call those referrals, I'm going to ask them who else they know who knows Emma, who I can call, because that first level of referral, you've already told them I'm calling. So
Yes.
they know, oh, yeah, Emma's great. But that second level is not aware of it. And then if I can
Oh,
get a third referral, because now as I want somebody to go and check on my character today, because this becomes a character issue more than anything else. So I welcome somebody to go find people in my life to find out what my character is.
hmm,
And for people to say, yeah, he's a good guy or he's not a good guy and stay away from him.
yeah. Excellent advice. My property manager gave me the same advice. He says, never call or don't bother with what the current landlord says because they just might want him out. Call the landlord before and get the real story on the tenant because they don't care anymore. So, as we're wrapping up our last couple of minutes, I really want to shift gears to your future progress, like your next passive income adventure, because you're obviously in this because you want to do well financially and you want to have some control over your lifestyle design while you're providing jobs and while you're providing great places to live. So, as you come out of the pandemic and been rebuilding everything, what is it today that really drives you? And what is it that you're working towards right now?
Yeah, so great question. I think a couple of things. One is coming back from all of this. I have a very good friend who has been in the business for a lot of years and is very successful and is the chief investment officer for a well known company. And he says that I'm going to be the Michael Milken of multifamily. And if you don't know who Michael Milken was, but he was the junk bond guy back in the 80s. And I want to live up to those types of expectations today. And I want people to say you're a bad person to not be able to say that. I want people to see that I can make a difference in other people's lives. And I try to make a difference by sharing my story because I don't think people need to be hampered by their past. They can't let their past dictate their future, and they can't let their past hold them back. So I want to provide hope and
Hmm.
inspiration for people to grow. That's all on the personal side, the character side, right? On the business side, listen, I'd like to own a few thousand units. I don't need to grow a multi-$100 million company. Passive investing, going around telling my story, that's a lifestyle for me today. What can I offer? We're syndicating deals. I'm coaching and teaching people. I'm selling some information in a box that people can get and educate themselves with. And it's a quality life today.
It's a powerful story that you've shared with us, Mike. And I feel like for the listener, especially the part about watching you overcome your fear and overcome your past and having that be a story of hope and inspiration so that we can see that this is a real lifestyle, this is a real thing, and it's worth spending the time to work towards. I want these stories to be extremely educational and uplifting and positive, because there's something that we can learn from everybody that we come in contact with. And thank you for sharing that with us and keeping the focus on the positive and what we can learn from mistakes and how we can carry forward in the future, and still find that inspiration and that hope to just keep working towards things that are really important to us. So appreciate you coming on today and being vulnerable and sharing with us your experiences. How can people get a hold of you? And I always ask, more importantly, why should people get a hold of you?
Yeah, thank you, because you'll learn to like me, love me, and trust me by getting a hold of me. First of all, social media. Any platform you're on, I'm on social media. My YouTube, I try to provide a ton of new content every day and give information, tips and techniques and things that'll help you. My podcasts, Multifamily Unplugged, Insider Secrets, and do a thing on Thursday morning called Thursday Morning Live, which we go live on LinkedIn, Facebook, and YouTube. That is just a really locally based Chicago. I bring on an entrepreneur from the area and talk about being an entrepreneur and leadership and things like that. That's just a fun thing I like doing. I'd love to give a copy of my book away, Emma. So if people want an ebook, they can go to mycoreintentions.com/free, go to short ebook on multifamily, or my book Exit Plan, which is your complete guide to multifamily investing and why you need an exit plan. And I wrote that because so many teachers out there teach you how to find a deal, buy a deal, operate it, but nobody ever taught us how to get out. And I want people to maximize their profit as a syndicator, as an operator, as an owner. And the other way is just to email me directly. I love to network. So if you want to connect with me, Mike
Awesome.
at Core Intentions. So
Thank you. And the way that I found you was actually by a referral, by somebody that I was chatting with, and he is in your coaching program, and he said that I definitely needed to meet you and talk to you. And that to me speaks volumes, just as you recommended before. Talk to people in your network and find the people that are going to help you. We're part of your network here on this podcast. We want to be in your network. We want you to reach out and contact us. That's why we put this material together, is so that we can be in one another's network. So be sure to reach out to Mike after the show and enjoy what he has to teach and what he offers freely, because we just like doing it. So thanks so much for being on the program, Mike.
thanks for having me, Emma. It was my honor. Thanks.
I don't know about you, but that story I found to be extremely moving. We're not dealing with small amounts of money in these types of investments. They can be extremely low risk. In fact, multifamily has some of the lowest risk adjusted returns in the real estate industry and in investing in general, which is why I love it so much. But it's really important to make sure that we have a great relationship with our operator, that we know how they're going to get themselves out of trouble when that inevitably happens. It doesn't happen on every deal, but if you're in this business for long enough, you will get a problem property that you have to get really creative on how to solve those issues. The questions, the red flags, and the lessons that Mike shared with us are invaluable as you continue your education towards being able to invest more confidently so that you can live your passive income adventure dreams. Be sure to reach out to Mike after the show, and I'd love to talk to you as well. You can find me on my website at www.highrise.group/contact, where I have links to all of our socials. You can reach out using whatever method is the most convenient for you. My number's on there for you to send a text message. We have a place where you can book a free call on our calendar or an accountability challenge call if you are needing some help reaching your goals. If you're overwhelmed by all of this, we're here to help. I love to teach, just as Mike said. We just can't help it. If we really love what we do and we enjoy serving people and being with people, we really want to share that with you. As we're going down our own journey of this passive income adventure, becoming full-time travelers and retiring early, working part-time, I just want to share the inspiration that this is a real lifestyle, that there are things that are important to learn. There are pitfalls that are important to know how to avoid or recover from. But at the end of the road, it is a beautiful adventure. So thank you for spending some time with me today learning about that. And I'm looking forward to you about your next passive income adventure.